Hello and a warm welcome to this quarterly update from SKAGEN Kon-Tiki. Today we are going to talk a bit about how the fund performed the last quarter and what possibilities and threats we see going forward. To answer those questions, portfolio manager Knut Harald Nilsson has joined me in the studio. First of all, Knut Harald, let's have a look at the highlights of the second quarter for SKAGEN Kon-Tiki.
Sure, let's do that. It was a weak quarter for emerging market, down about 10%, but we fared fairly well relative to the index though. We were down about 7%. Emerging market has been very weak this year, has been about 10% down in euro terms versus the return of global shares in general of about minus 1% in euro terms. Compared to last year where emerging market outperformed slightly, we've seen a sharp pullback also in terms of flow, which has come in return now from March. Significant outflow from emerging market during the second quarter. Lot of that I think has to do with disappointing earnings development last year, so it's actually in the aftermath of that. And also some unrest situations as we've seen in Egypt, we've seen in Turkey, and latest now in Brazil. And also some fragile macroeconomic situations in several countries like Brazil, for instance, which is struggling with very low growth, near 1%.
We're going to talk a bit more about this, but when things like these happen, you often say, all right, this opens opportunities for us. How would you relate to that now in the current situation?
I think what you see now in emerging market is quite a diverse situation. You see some countries growing quite rapidly, 6-7%, and as I said, like Brazil and Russia struggling with the growth. So I think it's very important to focus on companies and not emerging market as an asset class, because you have to find those companies that are able to grow sustainably and on their own because of a growing market or a low penetration, etc. So those pockets we are definitely looking at now. There's been a lot of focus on growth in China coming off. China still growing 6-7% of what we've seen in the past of 10%, and that has also scared off people. There's definitely some challenges in China in terms of corruption, in terms of balancing the economy, but there's definitely also opportunities, as China has been one of the worst performing markets over the past 3-4 years.
Very well. All right, let's have a look at the results.
Yes, we managed to do almost 3 percentage points better than the index in the third quarter. Year to date, we are about 6% ahead of the index, 5.3 to be exact. So that is okay. It's definitely not okay to be down on the year, but obviously emerging market has been weak. I think when you look at the results from our companies in the first quarter was very good. So far in the second quarter we haven't seen many reports. They're starting to come in. But I think most of the companies, larger companies in the portfolio has actually delivered quite well.
And compared to the other markets in the world, how has emerging markets done?
As I said, in the second quarter, emerging market was down 10% in euro terms, global equities minus 1%. And you can see on this chart that a lot of the market that has performed fairly poor is the BRIC countries, with Russia, Brazil, you see at the almost bottom end here, Russia, Brazil, China, India slightly ahead of the index in the second quarter. But you see that some markets like Czech, Poland has done fairly okay, but predominantly the BRIC countries has been driving the weak performance, especially as I said, mentioned Brazil, which is in a situation with quite high inflation and price pressure. and has now raised the interest rates they did yesterday by 50 basis points for the third time in, I think it is 4 months.
What effect will that have, do you think?
I think what they're obviously trying to do is to create more stability in the economy. They have great challenges with low unemployment among skilled workers, high cost inflation because of salary increases. And you also see now that the currency has weakened significantly during the second quarter. So Brazil is a challenge, but obviously that creates some opportunities, some exporters that are benefiting from the weak currency. So we're looking into that. During this year, we have sold out of Electrobras, we sold out of Petrobras. We have increased Vale a little bit lately, actually.
Very well. All right. Main contributors in second quarter.
Yes, it's continued to be more or less the same picture as we saw on the winning side. We have our car manufacturers, which has done very well. Hyundai, especially the preference shares we own, which has outperformed the ordinary share by 40 percentage points over the past year, because the discount on the pref shares became too high, and it became a lot of focus in the market on this discount. Also Great Wall that continued to deliver excellent numbers. First half sales was up by 40%, and that is in a market that was up about 10%. Their strong focus on SUVs, which is outgrowing the total market, and also the fact that they're gaining market share, has benefited. Sistema was also a strong contributor on the positive side in the second quarter, and the reason for that being that it was sold down in the first quarter. They did an excellent job by selling one of their oil assets recently. They bought it in 2009 for $100 million and sold it for $1.3 billion now in the deal closed yesterday, actually. On the negative side, Empresa Sica, which is a construction slash concession company in Mexico, which performed very poorly due to increased focus on their debt level and financing, which made their bond yield coming up sharply from about 6% to about 13%. So that was a negative contributor. They have fixed some of the debt problems here by selling assets, so repaid 60% of the short-term debt by two asset sales they did, so it's looking a little bit better. Also Vale, which was a victim of the Brazilian market in general, and also a negative return for raw material stocks. This is basically overholding in that sector of larger size. We think iron ore prices has held up fairly well, and stock has been a victim of the Brazil, as I said. So we actually increased a little bit in that lately. We're not overly positive on the commodity side, because we think that the rebalancing of the economy in China from infrastructure investments onto consumption is going to have a negative impact on demand. China's iron ore consumption is about 70% of the free market consumption in the world, so it's very important. Gazprom, also a victim of the Russian market, and also of negative news on the dividend side, you can say. We expected more to come. It seems like it's coming, but it's coming slower. So in net, a fairly good quarter on the relative side, driven by then Hyundai and Great Wall, which has been very good contributors to the portfolio over the past 4 years as well.
All right. If you have a look at the changes in the portfolios in the second quarter.
Yeah, we have two new holdings in the portfolio. It's Kinnevik, which is a media company in Sweden, controlled by the Stenbeck sphere. A lot of their assets is actually listed within telecom and media, but they also have a significant exposure to internet, which we think it's undervalued by the market. So looks very, very good. Actually, their internet assets is probably valued at is worth the double of what they have in the books. Very interesting company, and the positioning. It's basically a little bit the same as our investment in South Africa, Naspers, which is also a company with stable cash flow from their TV business, investing in internet. So we think that is very interesting. Also LG Chem, which is a chemical producer of derivatives in Korea, but also have very interesting positions in batteries for hybrid cars, etc. So we added that to the portfolio. It's been weak because of weaker commodity or chemical prices, but we think the market has not focused on their new business, which is growing quite rapidly and looks quite interesting. On the side, what we sold out of Aberdeen after a fantastic ride, more than doubled our money since we bought it back again in August, September 2011. We also sold out of Thai Bev after a gain of about 50% in 6 months, and some smaller position. We also, to mention that, sold significantly down in Baker Hughes, which we are concerned about the overcapacity in the pressure pumping side in the US, and which has actually performed quite strongly recently. We also took out some smaller positions in the commodity space to refocus on, for example, as I mentioned, Vale. And we sold out of Citibank, which was also a small position after a fairly good gain in 6 months.
Very well. Let's have a look at the valuations of the largest holdings in SKAGEN Kon-Tiki.
Yeah, as you see, the concentration of the portfolio has increased a little bit, and that is our hope to increase that, to put money behind the best ideas. So we should run a concentrated portfolio. If you look at the valuation at the moment, over 35 biggest holdings, which is almost 80% of the fund, is trading at 6.5 times earnings this year, and a price book of 1, with a dividend yield of close to 3%. That is very attractive compared to the emerging market in general. And having said that, after the significant underperformance of emerging market, that asset class also looks very attractive from a top down in the equity space. Having said that, you have some challenges. You have unrest, as I mentioned. You have budget problems. You have low growth in some of the commodity-dominated economies like Russia and Brazil, as I mentioned. So it's very important to find the pockets or companies which are able to grow by their own destiny, and be able to increase in a market that is growing and maybe also gaining market shares.
But having all those kind of problems that you're now talking about, at what time do you actually see that emerging markets will bounce back and be in forefront of economic growth?
Well, we saw Bernanke step on Wednesday night saying that they're not going to end the QE3. I think you saw emerging market bonds significantly on that time. It looks very cheap now, relatively. If it gets a little bit cheaper, I don't know. But I think it's important to focus on the companies and not the markets, because we don't own the market, we own companies, and companies are making money. And to find those companies that are developing very well, that's our aim. We don't need to invest in Chinese banks, which we haven't, for example. I think the investment philosophy has worked fairly well this year. A few negatives, but mainly some positive surprises and companies delivering according to what we expect. And so that's what it was we are focusing on. In terms of flow, we've seen, as I said, a significant outflow of emerging markets. It seems like investors, it's mostly hedge funds pulling out, and that's more a risk-on, risk-off trade in the short term. And you also have the situation with the developed market equities, companies increasing their exposure in emerging markets. So you really need to dig down to companies and see what's the drivers behind them.
And that's basically what we do at all times, isn't it?
Definitely.
Very well. Let's flip to the last slide, because our time is merely up. And I would just like to remind you that in a few days, we will have a new market report ready for you. And if you want to read more about how SKAGEN Kon-Tiki has performed or the other funds in our portfolios, do have a good and thorough read, and we will publish it on our websites shortly. I guess that's it. Thank you very much for watching, and have a great summer.